The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. US majors closed sharply in the red as Jerome Powell says the Fed is in wait-and-see mode until the impact of Trump's tariffs become clear, but warns the US faces rising inflation and a weaker jobs market.
We are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We will continue to do everything we can to achieve our maximum employment and price stability goals.
A semi-conductor slump. Nvidia tumbles after revealing a $5 billion hit from US export controls, dragging its peers lower.
Siemens Energy, meanwhile, ups its outlook after a forecast-beating second quarter, with the German company posting its highest profit margin since its spin-off. And the Italian fashion group Moncler bucks the sector slowdown, reporting a first quarter beat after a disappointing set of results from LVMH earlier in the week dragged the sector lower. Now, good morning, how are you?
Good morning. Happy Friday, by the way.
Yeah, you're so funny. Actually, it's still probably Tuesday for me, somewhere in the world. Yes, indeed. You're referring, of course, to my faux pas yesterday, where I'd missed a day of the week.
Yeah,
where you reminded me I'd run on Monday, hadn't run on Tuesday, ergo it was Wednesday. Yeah. Yes, it is Thursday, but it's our last day of the week, isn't it? So, now, there are different ways of trolling your enemies. You can be very blunt about it on social media, or you can say nasty things about people, or you can be very, very straight-faced and you can just say the facts as you see them. But
are you talking about Japan or China here?
I'm talking about Jay Powell.
Oh, right.
Because I'm sure he's not trolling Donald Trump, but the way that he delivers his very straight-faced analysis of the US economy, and it's very accurate, I think, as well. We'll come to, you'll read what Jay Powell said in a moment as well. It is the antithesis of what Donald Trump doesn't want to hear. Let's take a step back. Donald Trump, the real estate entrepreneur who always wants lower rates. That's what all real estate entrepreneurs want. They want a lower cost of finance so they can gear up and buy more property, more real estate as well. So you've got Jay Powell saying, we're not going to hold your hand, market. And at the same time, I just wonder if, and you'll never see that wry smile from Jay Powell, and you'll never get an admission from him, but that's what he's doing. But I wonder if he's just saying, no, this is how it is economically for those who don't understand what has to happen when you do other things.
It's the ultimate leverage, isn't it? He's holding the trump card, effectively, this rate cut decision. And the reality is that markets have been roiled, been very uncomfortable, and would an interest rate cut shore up the market? And you've got to say that is the one thing Powell is holding back on at this stage. So it is remarkable, as Trump really seems to be in the position with the upper hand in a lot of trade negotiations. But the ultimate power here when it comes to this decision is with Powell. And I've got to say, if Trump did push back, and again, he's been very vocal about the need for lower interest rates, if he did, it actually undermines the strength of the institution, which then, and again, undermines US treasuries. So he's going to be very careful about how aggressively he attacks Powell. He really can't win either way when it comes to Powell.
And what's the big read in the FT today? It's all about, are we beginning to see the end of dominance of the US dollar? A really interesting read there as well. Anyway, what did Jay Powell say?
Well, the latest here is that Jerome Powell says the Fed will hold steady until the direction of the US economy is more clear. This following President Trump's decision to ramp up tariffs on America's trading partners, including imposing a 145% tariff on China. Speaking at the Economic Club of Chicago, the Fed chair said the larger than expected hike in tariffs, along with the Trump administration's new fiscal policy and regulation changes, means the Fed will stay in wait-and-see mode. Powell also said tariffs will likely put the Federal Reserve in a tough policy position, facing up to rising inflation but also a weakening labor market.
The administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So Unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public.
I just want to point out the lack of clarity here today, because don't forget the ECB is making its decision. And the reality is, when you get the hard data, the survey data, you put it all together, you get a fairly clear picture. But the reality is, because the uncertainty has stretched on much longer than Liberation Day, with this 90-day pause, central banks don't have the clarity that they thought they might have at this point. So it's not just the Fed, it could be the ECB today as well.
Yeah, absolutely. Right, let's move on to the retail sales, which jumped actually. So the consumer ostensibly robust. They were interesting numbers though. US retail sales jumped the most in more than 2 years. Now look, much of the extra buying was spurred by households rushing to avoid the impact of tariffs. Total retail sales were up 1.4% in March, with receipts at auto dealerships up more than 5% in the lead up to Trump's 25% tariff on auto imports. So you can see, again, a skewed number. We need to look at the smoother, perhaps three-month figure to see the wider picture. But Mike Gallagher is the Director of Research at Macro and Strategy at Continuum Economics and joined us now. Mike, really nice to see you. You would have heard my comment about Powell trolling Trump by just being so kind of, not po-faced, but so straight-faced about the underlying economics. I'm sure he's not trolling Trump, but he is pointing out that there are very, very important ramifications that the Fed will have to react to.
Yeah, I mean, absolutely. Look, I mean, the second quarter data on inflation is going to be ugly. We're going to get big jumps in April and May CPI in all likelihood, given the tariffs that have actually been implemented and that are going to hit the US consumer. And so, you know, you've got to see the real sector data as well, because there will be a deterioration. But, you know, is it going to be along the lines that we're thinking, which is to slow down to 1%, or is it going to be a harder landing, which could mean a mild recession? You know, a mild recession is something you can't rule out, and consequently, data is going to be absolutely critical to the markets and Fed policy perceptions, and actually Fed action in the next 3 to 4 months.
So, let me move on, because you've raised the point there. No, that's great. You are writing a piece today, which I think runs very well with the piece I just mentioned in the FT. The big read in the FT today is the world losing faith in the almighty US dollar? You've written a piece in the last couple of days. In fact, on Tuesday, there was a lot of Tuesdays this week as far as I was concerned, because I misread where we were. Nervous US long-term asset holders. And I think we're all kind of saying the same thing, or asking the same question. Is there a problem with the dollar? Is there a problem with holding US treasuries? I.e., not today, but over the medium term?
Well, I think there is, because, you know, if you look at, you know, foreign equity holdings, according to the Fed and US Treasury data, they were about 17 trillion in the middle of 2024. And, you know, people have to sort of ask, well, has US exceptionalism ended? It probably has. With Trump's policy to try and reshore, it's going to squeeze corporate margins longer term. So there's going to be a degree of further reduction in overweight US equity positions by foreign accounts. And then when it comes to US Treasuries, certainly the thing with US Treasuries is that the nominal and real yields are quite attractive compared to other G10 bond markets generally, and particularly against the Eurozone and Japan. But, you know, some of the holders of treasuries, including foreign officials, governments, are already on a process of diversifying away from US treasuries. So China's been doing this for years. And I think China, irrespective of what happens, will continue to diversify away from dollars. And if there's a hard break between the US and China economically, that the tariffs aren't resolved, then, you know, China doesn't have the incentive to hold the amount of treasuries, which the official figures suggesting is about $750 billion. And that's not just China. I think other central banks as well could well lighten up. If you look at the data closely, Brazil and Saudi Arabia have already been doing that in the last couple of years. And I think private sector investors, will buy treasuries if the yield is above 4%, but will only buy them below 4% if there's a recession in the US. So I think all of this means a lower dollar. For us, we're looking for 120 on euro dollar this year, and we're looking for 135 on dollar yen, and then even more next year.
Mike, this is in line with the Bank of America survey of managers also thinking the dollar would decline from here. In terms of the beneficiaries, you mentioned Europe. I know one fund manager was telling me the other week, typically he would be invested in US treasuries at this point, given the elevated volatility, but instead that money was going into European bond markets. Do you see that direction, that European bonds could take on a special sort of reserve-like category for some investors now, which ultimately improves the funding of a lot of European assets, as Europe has gigantic ambitions now at this stage?
I think Europe can be a beneficiary. And the reason for that is not just the size of Europe, but also the fact that we've got this US-China trade war going on. So by default, the third big region, Europe, although in a trade dispute with the US, is not in a trade war with the US. So there's a degree of safe haven there. I think then additionally, the European picture looks somewhat better going into 2026 with an increase in defense spending, which should ensure a recovery in Europe. So that's one of the reasons why we're looking for 120 and then an extension even further. Look, I mean, if you sort of sit down and do long-term calculations on euro dollar, you come up with a figure of 130. The dollar is extremely strong on a long-term basis. It's very overvalued, and it's got a long way to fall potentially. We don't think that will occur rapidly because we think the interest rate differentials are still quite large in the dollar's favor, but they're not large enough to stop a dollar decline.
I see. Mike, very quickly, we haven't got much time. I want to ask you about the ECB. What does it do today, given that it's got a very short-term picture of some threats around tariffs, but long-term it's got the fiscal spending coming?
I think it does another 25 basis points because the tariffs are more important. The fiscal spending is a story for next year. So 25 basis points delivered and another 25 in June and then another 25 in the second half. They've got to deal with it. Tariffs are disinflationary for Europe.
Mike, thank you so much for joining us at this early hour. Mike Gallagher with us, Director of Research, Macro and Strategy at Continuum Economics. Well, as we mentioned, we're counting down to the ECB's rate decision today. The central bank is all but certain to cut rates, with markets pricing near 95% chance of a 25 basis point move lower. All eyes will be on the guidance as policymakers look to assess the impact of US tariffs on growth and inflation. Onetta has more from Frankfurt. Onetta, there are so many moving pieces here. We don't have the clarity now with this 90-day pause, still negotiations around autos. And of course, we're getting a mixed picture on inflation with some prices actually coming down and others going up to compensate for the higher tariffs at the US borders. So what do you think the ECB is going to be communicating today?
It's probably still a very cautious approach the ECB is taking. They're not known for being very bold, such as the Fed is usually when they're enacting their policy measures. So I would also say that they will err on the side of caution, and they will probably cut another 25 basis points as the uncertainty around the economic outlook have risen so much, and that the majority of economists actually think that the tariffs could have disinflationary effects here in Europe, be it through a lot of goods coming from China here to the market, and also that the prices in general can't be hiked as much as before. So I guess this is what the ECB is still considering, whether the net effect of these tariffs will be disinflationary. And I think they will actually really look at these forward-looking economic indicators, and we still have to wait for the PMIs. They only come next week, which then will factor in also the tariff shock. And I guess as the ZEW index here for Germany, which actually just tanked on the news, we'll see a similar picture when it comes to the real economy forward-leaning indicators, such as the PMI and also the IFO index, which will be out next week. I think it's Wednesday or Thursday. So I guess this is what the ECB will wait for. And of course, they will still look at that domestic inflationary picture, especially when it comes to wage growth. And I think here we most likely see a serious abating of that sort of move up when it comes to wages, because the labor market is feeling first deteriorations when it comes to manufacturing jobs, but that is something which is valid across Europe. And of course, we have to look at the individual countries as well when it comes to inflation. For example, Spain and France, they are actually showing or showcasing too low inflation, even for the liking of the ECB. So it's a very difficult picture, but I guess they need to cut another time, and they will be forced to cut this time because of the tariffs, and they will most likely cut more times to come because of the uncertainty in the economy.
Annetta, thank you very much. I think it's going to be a fascinating day for anyone who follows the macro. If you're an economics nerd, the language the ECB is going to be using will be fascinating today. And for more on what to expect from that ECB decision, you can check out CNBC.com. We will bring you that decision live from 1:10 London time. And Christine Lagarde's press conference will be live on the CNBC International Live YouTube page at 1:45 London time.
Nvidia, wow, I mean, if ever there was a stock that was doing rather well until the tariffs, this is it. Nvidia is continuing Wednesday's decline. Now after a weak report from the chip equipment maker ASML. Also, overnight, and this is a story that probably moves it on a bit, which you may not be aware of, a House Select Committee investigating security threats from China has opened a probe into whether DeepSeek, the Chinese company that upended the AI industry earlier this year, used chips from the firm that are subject to export controls. America's Select Committee on the CCP released an investigative report on the Chinese firm on Wednesday, which was yesterday, I'm told, calling it a serious national security threat to the United States. The chair, John Moulinar, accused the company of exploiting American AI models and reportedly using tens of thousands of Nvidia chips to power its technology. The move comes after Nvidia announced it will incur $5.5 billion in recurring costs from a US government decision that a chip company that the company developed to comply with Chinese export controls didn't, in fact, meet those controls. Nvidia said it follows government directions to the letter and pointed to the billions of dollars in tax revenue it brings to the United States. Okay, coming up on the show, the WTO gives a really downbeat verdict on Trump's tariff measures, but Moncler says it doesn't expect a material impact from the levies on its prices this year. And we're going to speak in around about 30 minutes' time to the ABB CEO, Morten Wierud, as the company announces it will spin off its robotics decision. That conversation coming up, as I say, in circa 15 minutes' time.
The World Trade Organization has downgraded its outlook for global trade after US President Donald Trump's sweeping new tariff measures. It now expects world merchandise trade to decline by 0.2% this year. That's nearly 3 percentage points lower than it would have been without recent policy shifts. Sylvia asked the WTO's chief economist, Ralph Osser, about the impact of the tariffs on Europe.
It's affecting all regions. It's also affecting Europe. But if we just go through the regional kind of pattern, North America is the most affected, Asia the second most, as you would expect with China. Then South America, because of its geographical proximity to the United States, and then you have Europe. But of course, that's the aggregate picture. If you look at individual industries, I already mentioned automotive. You also have steel and aluminum. That's, of course, important. But I think for Europe, the main focus at this point is really these trade diversion effects and how they can be managed.
Sylvia also discussed with Osser the outlook for China amid trade tensions with the United States.
Trade diversion is certainly an issue that many of our members here have raised. We have done some analysis also in this report. where we show that Chinese exports are going to increase by somewhere between 4 and 9% for all regions outside of North America. But one thing that's really important to keep in mind is that this is a two-way street in a way. If you think about European firms, for example, trying to export cars to the United States, they also face a 25% tariff now, and they will also need to find new destination markets for these products. So it's not just Chinese goods coming into Europe, for example, but it's also European goods that need new customers. And it's really important, I think, that these trade diversion effects are managed cooperatively.
The Italian Prime Minister, Giorgia Meloni, is in Washington ahead of talks with the US President Donald Trump. She's the first European leader to meet and hold discussions with Trump since he announced his sweeping tariffs. Well, Sylvia joins us with more. Oh, she's often been talked about as the bridge, hasn't she? Because she gets on well with Donald Trump, and of course she is one of the most important leaders within the EU, and actually has been doing okay in Italy, compared with expectations since she got to power. So just tell us about how this one's going to go down.
The question is, can she deliver? Because yes, she's positioning herself as the bridge between the EU and the United States amid this trade war between the two. But ultimately, let's see what will be the outcome of these meetings. It's worth to keep in mind, of course, the relationship between Meloni and Donald Trump. She was the only European leader that attended the inauguration of Donald Trump. So that also highlights how close to some extent they are. Donald Trump has had very warm words about Meloni. He has said that she is a wonderful woman, a strong leader. He has also said that he loves Italy. We also are aware of their similar ideologies, their similar political positions. They also have similar views when it comes to China. However, the president might push Meloni when it comes to defense spending. Italy is still not yet complying with the NATO defense spending target, and this could be a point of divergence between the two leaders. But when it comes to trade, this meeting is very important because there's a lot on the table and on the line for Italy itself. Italy also exports very heavily into the US. Last year, they had a trade surplus with the US about 40 billion euros. And of course, European leaders are looking at Meloni and hoping that she will manage to get some concessions, not just for Italy, but also for the EU.
Let me address one of those points. Italy is arguably hypocritical when it comes to the NATO side of things. But no, not arguably. It is hypocritical. It's nowhere near the 2%. It's signed up to the 2%.
Yeah.
It does have a close relationship with the United States for all kinds of cultural and historic reasons as well. The fact is, the Italians are one of those key nations in Europe who are failing ignominiously to get near to their target. 1.57, 1.6, you can split hairs here. They're nowhere near the 2%. They're nowhere near the 2.5% that some European nations have said is the minimum, the 3% that some have said is the minimum, the 5% that Trump has asked for. Presumably, Trump should be lambasting Meloni.
And he might. He has in the past when it comes to their defense spending positions, right? But the question that the point I would raise there is in fact two. I was actually very interested in the conversation I had with the Portuguese finance minister some time ago, Rossetti, actually. Because they are in a similar position. Portugal also doesn't respect the NATO defense spending target. However, his point was we have different priorities, and Italy is in the same position as Portugal in this one. They are looking at the Mediterranean as a
cop-out. And the Spanish are the same.
And at the same time, they're also saying, this is just their arguments, right? The other argument is we need to be very wary of our fiscal positions.
Look, if I joined a club and they say I have to wear a tie to go into their club room, and in fact I do belong to a club which says I have to wear a tie to go into the club room as well.
You should wear it.
I wear a tie. If I don't want to be a member of that club, they'll take my tie off and go wherever I like. Totally. The fact is, they have committed themselves decades ago to the club rules. The club rules are 2% minimum. If I'm Spanish, if I'm Portuguese, if I'm Italian, it doesn't matter that I'm looking at the Mediterranean as well. If I want to be in that NATO club, I'll spend my 2% plus or get out the club.
The point now is that 2% is not even enough anymore.
It's not even enough.
And we have that NATO summit coming up, and we might even see 4, even 5% as the new target.
I understand the threat to the south. I've spoken to Tajani about this. I think I even mentioned it to Meloni once as well. The fact of the matter is, yes, there is a humanitarian and geopolitical and societal crisis coming from the Mediterranean, from North Africa, from MENA, from Syria. I understand that refugee crisis, but that is conflagration of two different ideas.
two different ideas, but they are aware they will be spending more, and they are saying they will be spending more. The question now is, what is the new target, and what are they going to define as new defense spending? Because that is also important to understand. Can you reach 3? Can you reach 4%?
Yeah, which goes to the heart of whether you get the fiscal spending that the markets are anticipating around this Make Europe Great policy. Because if you're a skeptic that the money's not going to be spent, it suggests that maybe markets are over-egging the amount of spending that's going to take place in Europe because of the weaker nations. And as you point out, whether you're wearing an Hermes tie or a Charles Turret tie, a big gap in what you're spending on that tie to get into the club.
Do you know the big question is? Whether actually that Hermes tie is actually made by the Chinese now. Because you both should know, well, I don't know if you've seen the latest, but there are concerns that actually something that's been under the surface for a long time, that a lot of luxury goods, I'm not talking about Hermes, by the way, I don't want to be sued by Hermes. I do like my Hermes ties, but the fact of the matter is...
Anything else with a monogram you don't want to be sued by either.
Whatever. But the fact of the matter is, there are real concerns that some of these luxury goods are finished off in Italy and France and are actually made by the Chinese as well. And there's all kinds of caveats in the contracts where this can't be revealed. And I think there's a little bit more information coming out on that front at the moment.
Which takes us to our next story, doesn't it?
Does it? Okay, yes. Different end of the spectrum.
Right.
I don't own a tie by Temu or Shein. It's true. Chinese, thank you. I'll see you later. It's great as ever. And I didn't miss the allusion to to my OB, which you took.
I was asked to do it, and I did it, and I'll happily do it again.
You're welcome. It's lovely, isn't it? That's Amber says. It's all mine. No, yours, mine. Yours, mine. Chinese e-commerce companies Temu and Shein have cut their ad spending in the United States. There, you can have it. And said they will raise prices this month, citing higher operating expenses. It comes as e-commerce giants wrestle with the impact of higher US tariffs and the end of de minimis import duty exemptions.
Actually, I noticed a Temu ad on one of my feeds yesterday. So I wonder whether they're beefing up on Europe. Nothing.
Don't you just love it when you say something near your phone and all of a sudden it just turns up?
You know what you're going to be looking at all weekend, Temu and Shein ads.
Maybe not.
Let's push on to tea. A Chinese tea company, Chuggy, is looking to raise around $400 million when it lists on the Nasdaq today. The chain, which specializes in coffee-inspired teas like tea espresso and tea puccino, apparently that's the thing, is priced shares at $28 each, according to Reuters, citing sources. Why did China? You might like this. I know you don't drink coffee. You might like a tea that looks like a cappuccino. That's not coming through in your face right now, though, I can say. You're thinking the infusion, the crossover of tea and coffee is just not your thing. But it's a very American, isn't it? Like the donut with the muffin.
If you have perfection, why change it?
The donut with the croissant.
No, builder's tea, a little splash of soy or oat milk.
It's called product innovation in the food category. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.